outside of the traditional banking system. Banks tend to be regulated and supervised, so a lot of financial information occurred outside of the banks. Things like non-bank mortgage lenders, things like these sieves or conduits, things like hedge funds or broker dealers or private equity or money market funds. Now, one of the features about all of these non-bank financial institutions has become now problematic, we realize, is that in many dimensions, they look like banks. Why? Most of them borrow short-term in liquid ways. Most of them tend to be highly leveraged, more leveraged than banks, because they're subject to less regulation. And most of them tend to lend or invest in ways that are more illiquid and long-term. Now, this problem of borrowing short, leveraging, and lending long is the reason why we know banks are traditionally fragile, meaning you can have a run on a bank that is solvent but illiquid if everybody decides to take their money out of the bank, a bank run. Because of that, we realized 100 years ago we needed to create stability in the banking system. So we did two things. We created deposit insurance, so you don't have to worry about your deposits, and then we created central banks. Central banks were not originally created to smooth inflation and growth. They were created to provide lender of last resort support to the banking system in case there was a run. Now, because of the existence of deposit insurance and the lender of last resort support of the central bank, we don't have runs on the banking system. However, all these other members of what's called the shadow banking system, all these non-banks that look like banks because they borrow short, they highly leverage and lend long, look like banks that are subject to runs. And what we've observed for the last year and a half has been the demise of this shadow banking system, because one after the other, most of the institutions of this shadow banking system have been subject to a run on their short-term liabilities. Started with the collapse of 300 plus non-bank mortgage lenders, where essentially their financing disappeared once people realized they were doing toxic underwriting. Then you had the collapse of all these sieves and conduits that were financing themselves short-term with asset-backed commercial paper and investing into toxic MBS and CDOs. Then you had the run on all the major broker dealers. Two of them went belly up, Lehman and Bear Stearns, and the other three were essentially forced either one to merge Merrill with another bank and the other two to convert themselves into bank holding companies and be regulated like banks. And now there is a beginning also of a run on money market funds. That's why we had to introduce deposit insurance. And there's also a beginning of the unraveling also of some parts of the hedge fund system with the redemptions going on and their ability to essentially leverage themselves being reduced. So literally, we have a situation in which the entire financial system that had been created as a shadow financial system right now is collapsing. And therefore, we're going in a world that is going to be very different, in which essentially there's going to be probably a merger between the traditional banking system and the non-traditional shadow banking system, in which the regulation of the financial institution will have to be very different from the past. You know, in the past, banks were regulated more, broker-dealers were regulated less, and hedge funds were not regulated at all. But I think one of the lessons of this crisis is it doesn't matter whether you call yourself Citigroup or Goldman Sachs or hedge fund A, B, and C. If you're large and you're systemically important and you borrow short, you're highly leveraged, and you lend long, whatever you want to call yourself, you're like a hedge fund, and therefore you have to be regulated in prudential ways. You have to have liquidity enough, you have to have capital enough, you have to have lower leverage, you have to report certain things so people know what are you doing and so on. So I think that one of the consequences of this financial crisis is going to be really a complete change of the way we think about the regulation of financial institutions in a world of financial globalization. In the short run, however, I think that the key thing is going to be that right now there's a risk of a vicious circle, of a negative feedback loop going from the financial system to the real economy and from the real economy to the financial system. Why? Initially, of course, this crisis was triggered by a housing bubble that went bust and the subprime problem. And that led to a liquidity and a credit crunch that led that to an economic contraction. But now the economic contraction risks to lead to increases in delinquencies, default rates by corporates, by households, and these increases in losses are going to lead to further losses for the financial system, making the liquidity and credit crunch worse, having negative effects on the real economy. And final observation here. People say this was a subprime kind of a meltdown or a subprime disaster. In some sense, I would argue this is not just a subprime mortgage problem. Unfortunately, we had a subprime financial system because the same kind of reckless lending practices that occurred in subprime mortgages were occurring in near-prime mortgages, Alt A, prime mortgages, jumbo loans, home equity loans, piggyback loans, in commercial real estate, in unsecured consumer credit like credit cards, auto loans, student loans, in all the LBOs that were financing themselves with high leverage, with these leverage loans, and all the way to corporate bonds, a huge amount of issuance of junk bonds in the last few years, industrial and commercial loans, and CDSs. So talking about the subprime mortgage problem in some sense is an understatement. We've had the biggest and the most excessive asset bubble and credit bubble in U.S. history and became global because of financial globalization, and now we're essentially paying the consequences of a huge bubble that's gone bust. I think the important thing in the short term is going to be to do the most aggressive policy responses, monetary, fiscal rescue that limit the severe now collateral damage to the real economy coming from this financial collapse. And we'll see whether that's going to be feasible or not. Thanks.
Nouriel, thank you. You might be wondering how Nouriel got so smart about all of this. It's well known that as a student, you need to have a great advisor. And let's bring up now Nouriel Roubini's advisor when they studied together at Harvard, Jeff Sachs, director of the Earth Institute here at Columbia.
I can't take credit for training George Soros, but I can take just a smidgen of credit for training Nouriel Roubini. Just a little bit, and he makes me extraordinarily proud. In fact, both George and Nouriel have really done an amazing public service in recent years because they almost alone, the two of them, in different ways, not only predicted what was going to happen and warned very aggressively against it, but withstood a tremendous amount of abuse and skepticism and denial about this. Nouriel's a great analyst of financial markets. That has to be an understatement for George, who's proven it in so many ways. But George did something like Nouriel, but I think even bolder, which is basically he's almost single-handedly taken on the economics profession in the last 15 years in a series of studies and books and advocacy about the threats of instability. And it's a pretty aggressive profession, and it was a profession very, very proud of itself, and a profession which awarded itself one Nobel Prize after another to people who said that this kind of thing couldn't happen. So it's also an ingrown self-congratulatory profession which said that markets work, as George said, to equilibrate, and they don't get things wrong systematically, and certainly not enough to lead to the kind of profound risks that the world finds itself in right now. I think it is interesting to return, though, to Lee's wonderful introduction when he said that, in a sense, this was in the air in so many ways. I mean, we knew housing prices were soaring. It looked crazy. We knew that household saving was negative. And what is it that stopped so many from putting the pieces together, even though nothing was really outside of plain view? I think that in practice, if you had to put the finger on one profound weakness of the system, it really was Alan Greenspan's Fed. And it was Alan Greenspan himself, because our system really is organized heavily around this unique role of the central bank, which has two fundamental purposes in our economy. One is to determine monetary policy. And as both George and Nouriel pointed out, monetary policy was very, very aggressive on several occasions. Every time there was a slight sign of a downturn in the economy for the last 15 years, Greenspan would extraordinarily aggressively